The fact that we were building through a period of time when no one else was building meant that by the time that there was excitement about the space, we were miles ahead of everyone else. And this building momentum and use case, which I think we helped create, really put us in a very unique position and still does.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. We are now featuring quotes from listeners on the show. Today, we have one from AI Schrodinger responding to Travis Kling's comments on AI agents in the crypto space. AI Schrodinger wrote on X, quote, "AI agents in crypto are like Schrodinger's cat, alive and dead until observed. Whether it's a bubble or the next big thing might just depend on who's looking." To have your comment featured, write a review of the podcast or leave a comment on the episode on YouTube or X. This is the January 14th, 2025 episode of Unchained. Did you know the Stellar blockchain already powers over 550 million tokenized assets in 180 countries? Join the Build Better movement at betteron.stellar.org. Polkadot is the original and leading Layer 0 blockchain with over 2,000 plus developers. And the Polkadot 2.0 upgrade will be a massive accelerator for the ecosystem, making it faster, more secure, and adaptable. Perfect for GameFi and DeFi to build, grow, and scale. Join the community at polkadot.network/ecosystem/community. Today's guest is Zach Abrams, co-founder of Bridge. Welcome, Zach.
Hey, thanks for having me. I'm excited to be here.
Excited to have you. So crypto people frequently talk about how stablecoins are superior to traditional payments. And they will say things like they're the first real application of crypto that has found product market fit. But I don't know if people are fully aware of just what the current landscape of payments looks like and why stablecoins are superior. And frankly, why Stripe felt Bridge was worth an acquisition price of $1.1 billion. So I'd love for you to walk us through a payment transaction in TradFi, and you can pick, I know there's so many different types, so you could just pick one as an illustrative example, and then walk through one with stablecoins so people can kind of hear the differences.
Yeah, that's a great way to start. So I can walk through two very different use cases of stablecoins. So the first is a cross-border payment. And so someone in the US is sending some money to someone in Mexico, or someone in Mexico is sending money to someone in Europe. Generally, these payments happen in two different ways. One, which would be the traditional consumer way in which the payments work, is through what's called netting. So a company like TransferWise or Remitly or one of these other consumer applications has money in Mexico and has money in the US, and the consumer sends money in the US, and then TransferWise just spits out money from their balance in Mexico. So money doesn't actually move. They basically built this really complicated treasury management system to circumvent all the ways in which money movement is horribly slow. And the second way that money moves is through SWIFT. So this is generally the way that larger business payments move. So a bank in the US sends money to a bank in Mexico. It moves via a SWIFT payment, which is similar to an ACH or wire, but it's a messaging protocol for sending payments internationally. And what will happen is the US bank will send dollars to the bank in Mexico. The bank in Mexico will receive those dollars, and then it will be up to their discretion to convert them into whatever amount of pesos they feel is right. So generally with that payment method, you're paying 150 to 300 basis points and waiting around 2 days. With the netting method, you're paying around 75 to 100 basis points, and the payments are in real time. Stablecoins give you sort of the best parts of both worlds, in the sense that the nice thing about the SWIFT payment method is that money can move end to end without needing capital on both sides. So with the stablecoin payment, you can take $1 in the US, you can convert it into a stablecoin, you can send that stablecoin over to a partner in Mexico. They can convert that stablecoin into pesos and then disperse it locally. So you can use local payment methods in both countries. You don't have to use SWIFT, so you can use instant ACH or an RTP or whatever payment in the US, and you can use a SPAY transaction in Mexico. But you don't need to use netting, and you can do all of that for 50 basis points, 75 basis points, or even cheaper. So you get the speed of moving of using local payment methods with the cost that comes with, or even cheaper than the cost of netting. Another area where stablecoins are really popular right now versus traditional payment methods or fiat money is that in order to build a fintech application, you need to build it on top of fiat building blocks. And in the US, we have decent fiat building blocks, albeit it's still really hard to build a fintech application. In Europe, you have decent fiat building blocks. But most of the world doesn't have any building blocks. They have nothing on top of which someone can build a fintech application. So if you want to build a Chime for Argentina, or you want to build a Venmo for Africa, you actually don't have the financial building blocks to do it. In the US, we just take for granted that someone can, even if it's hard, someone can sign up for some banking APIs and open up an FBO bank account and store funds and move money and what have you. But in large swaths of the world, that's not possible. And so stable coins are actually providing those financial building blocks to the large, overwhelming majority of the world that doesn't have anything. And so now an entrepreneur in Africa can build a neobank or a peer-to-peer payment system or any other financial application that they think is right for their community.
Yeah, hearing you describe all this, it reminds me of basically the reason why I even went down the rabbit hole in the first place, and it'll be coming up on 10 years very shortly. Basically, I was doing this FinTech 50 list for Forbes, and I was vetting different companies in different categories. But one of the categories I had also was digital currencies. And so to learn about the rest of FinTech while I was learning about blockchain simultaneously, it was like so obvious. This was like vastly different and far superior. And the FinTech stuff was, as I put it, it was just like putting a digital veneer on this decades old infrastructure that we had since like the 70s. And so it was just funny, like in that first example that you gave, that was a little bit smoother with like a TransferWise or whatever, like that's supposedly the improvement. But could you just now then, I guess, summarize all the different problems that exist with kind of traditional payments? Because, it's, so you described a little bit about how they works, but, when I look into things like all the intermediaries, how long it takes, the cost, et cetera, like, if you could just like summarize that briefly, and then we'll move on to what Bridge does.
Maybe just to back up, when we started the company, we had this view that stable coins would be useful, but we didn't know exactly how they would be useful. And once we built our APIs, the developers who've been building on top of us have showed us how they can be useful. And I've spent a lot of time, like my whole career has been in the fintech space, but it was all in the US. And stable coins, the problems that they solve are all international. And so, I had a sense of, and Sean and I, when we started the company, we had a sense of what could be possible, but we didn't know exactly how stablecoins would solve problems for folks in Argentina or folks in Africa or folks in Asia and so on. And now it's much more clear because we have hundreds of teams building on top of us. And I would like, if I were to pull back, almost every use case is international in some capacity. The biggest problems today that exist with financial services have to do with the fact that it is extremely balkanized and incompatible across countries. And if you think about the financial landscape in like kind of a systems way, you effectively have a U.S. system that necessitates a U.S. bank account that only U.S. consumers can access, and then a European system with European bank accounts that only Europeans can access. and so on. And so you have all these incompatible systems, and moving money between them is extremely onerous and expensive. And so people have, it's either as a result just not possible to access alternative systems, or it's extremely expensive to move money across them, or slow. And stablecoins, in many ways, there's a bunch of people who are building different ways of solving this, make it either faster or cheaper or possible to access these different systems. And that's what's been really, really cool to see, is that with our APIs, a lot of developers, it's sort of created a new wave of innovation in the financial services space, because a lot of this just was not possible. People across Latin America cannot access US accounts easily.
But just to explain, because I think a lot of people have had the experience of going abroad and being able to use their credit card. So why is that not an optimal solution?
So if a US consumer goes abroad and uses their credit card, it works actually. And so I don't know if I would say that that's like a terrible solution. But if a US consumer wants to send money to a friend or family member or vendor in Argentina, that is super slow, incredibly slow, and very expensive. Or if someone in Europe wants to send money to someone in Africa, same thing. It's very, very slow, very, very expensive. You're generally paying hundreds of basis points to move that money. And if you're a business and you're moving large sums of money, it's going to be really slow. And you actually have no idea how much money is going to land on the other side, which is crazy to think about. So, you're paying a vendor and you owe them, 200,000 US dollars, but you're sending Mexican pesos. You actually don't know what FX rate the bank is going to apply on the other side. Or you're someone who travels a lot as a business, or business who does work across multiple jurisdictions. And so you just want the ability to store money in local currency, like maybe Mexican pesos, but also store money in dollars because your business runs in 7 different countries. Accessing a dollar bank account is really, really hard. And then moving money between that dollar bank account and your Mexican bank account is really, really challenging. Or you're an entrepreneur building for, 6 different countries, but all those countries are really small. So it's really hard to, if not impossible, to serve all 6 of those countries, because they all have very different financial systems, each one with an enormous cost to build and integrate with. So there's just a lot of these international problems that have, because they've been too hard or too costly to solve, that, the whole global entrepreneurial world has just ignored. And now stablecoins are making it possible to solve some of those problems.
And now explain what Bridge does and how it works.
At Bridge, we're building APIs, orchestration and issuance APIs that enable people to build with stablecoins. And our view is that stablecoins are kind of like a scaling layer on top of the fiat world. And so money will move from fiat up to the stablecoin layer, across and back down. And our APIs enable you to make all of those movements in whatever way makes sense for your business. The APIs are very flexible. Our whole goal is to serve developers and support whatever they're building. Those developers are building business applications that might be a cross-border payment app. They're building neobanking services that might be serving LATAM or Africa or wherever else. They're building card products that might want to serve consumers or businesses globally. They're building, crypto products that might need to support stored balances or on or off ramps. A whole host of folks are building, we're serving aid disbursements, global payouts for gig workers and so on. So in any capacity, if someone is doing something internationally, there is generally a role for stablecoins to play. And a lot of folks have come to us to build those applications on top of Bridge.
And those APIs connect both TradFi companies as well as stablecoin companies. And I guess like fintechs, and there's probably just like a whole host.
Yeah, exactly. So we started, and our first use case was serving crypto companies because that's who we thought were going to be the first people who use this. This was 2 years ago, and we just didn't know. And so we were working with a couple of crypto companies, and they wanted to give their consumers on and off ramps, and that was the first use case. That didn't end up being very big, and then we had some cross-border payments companies just inbound to us. And they were doing, the first one was doing cross-border payments from Colombia to the US. The second one was Mexico to the US. And then they showed us that this cross-border payment opportunity was real. We had heard about it. We had kind of theoretically gotten it, but it wasn't until they came to build on top of our APIs that we saw it. And then we had a government aid organization come to us to disperse aid payments via stablecoins. So they're sending aid payments into many different countries. Many of these aid payments are very small. So it is extremely expensive to disperse a large number of payments with a small dollar value to many different countries. In fact, 60 cents of every dollar was ending up getting to the end recipient. They predated our time. They moved over to stablecoins, and they needed our APIs to be able to do this easily. And now like 99% of each dollar gets to the end recipient. Then we had neobanks come to us because folks wanted to build neobanking services across LATAM and Africa in particular. Then we had large enterprises come to us that are selling services, all over the world, and they needed to manage their treasury. So move money from Argentina or Nigeria or Malawi or wherever back to the US so they could operate their business, and so on. So we've just had every 3 months, we've had some new use case emerge where somebody out there envisions a way in which stablecoins can help their business. And then we work with them to make sure that our APIs can support whatever they want to build.
And so now, so I don't know now how many customers, or I don't even know how you would qualify them, but how many people do you have, or how many companies? Because you're B2B mostly, right? It's not like you're, So how many customers do you have? And what categories do they fall in?
Yeah, so we have like our customers who pay us are developers, and then those developers have their customers. So yeah, so it is quite confusing. So we have several hundred. We have like 350 or so teams who are building on our APIs, and just across like a huge swath of folks. So it ranges from really large enterprises, like some of the largest companies in the world, to two-person teams that are just starting out and have some vision for what they want to do.
And wait, and just to clarify, when you said that you have developers building on you, and then you said some of the largest companies in the world, do you mean like they're engineers? And okay, so it's like, so some of them are actual financial companies, and then they get their developers to do this, and then some are just entrepreneurial developers who are going to launch something that would serve other people. Is that?
Okay. Yeah, got it. That's right. And the only thing that's probably common across all of them is that there is something global in what they are doing. And so that could be treasury management, like they're collecting payments in many countries. It could be that they're a marketplace and they're paying people out in many different countries. It could be that their customers need to send money across borders. It could be that their bank serves folks in many different countries. And so whatever it is, there's something that necessitates moving funds or serving consumers across multiple different countries.
All right. And one thing I noticed is you launched when the collapse of Terra Luna was probably still somewhat fresh in the minds of everyday people. Well, I think there's like two different dates. Then I think maybe you went live or something when the collapse of Silicon Valley Bank caused USDC to depeg. So I wonder, just generally, like, has there been an issue with misconceptions about stable coins being a hurdle, like, that you have to convince people, or maybe you've just kind of let people have their misconceptions, or how do you deal with that, if at all?
Yeah, I mean, we had the first year of the company was extremely hard. We basically pivoted into stablecoins, and Terra Luna happened, and then one of our first customers after we pivoted was going to be FTX. And FTX obviously fell apart, and then we built with a new bank, and then Signature Silvergate happened, and then that bank went away, and then we built again, and then SVB happened, and the week that we had launched for the second time, USDC depeg. And so we were pretty confident that after a year of work that the bridge was going to be, that no one was going to want to use stablecoins. I would say that the thing that really kept us going through it, and the thing that we believe was, I had spent a lot of time in financial services. One of my core beliefs with financial services is that over the arc of time, people are financially rational. People don't change overnight because the perceived risk of something new is high. And so they're being rational. And if the reward is low and that risk is high, then they're not going to do it. And with stablecoins, they're financially rational. It's a easier way of building financial services and a cheaper way of moving funds, a faster way of moving money. There was a very clear and obvious case for them to become a core part of our financial infrastructure, but the perceived risk was high. And so we kind of just knew that there was that at some point in time, the switch was going to flip and that we would begin to run downhill. But for the first year, we were certainly going uphill. And with each one of these collapses, the perceived risk was going up. And our big fear was that we were just going to be too early, that the perceived risk of stablecoins was not going to reach some low enough threshold for adoption to really flip for 5 years or 10 years or what have you. And we were going to spend it sort of toiling with a very small amount of early adopters. Fortunately, that did not happen, but it did look pretty bleak there for a moment. And the good thing though is that for us, the world, in some ways, the world moved really slowly. I worked at Coinbase when we launched USDC, and it seems like it's taken us forever to get to this moment in time. But then once we started to have a handful of folks using the API, it really, it really started compounding quite quickly. And as we started adding together more use cases, other people started leaning into the space and building. And so really that point in time after the SVB, that was, in hindsight, that was the low point. And then from there, we had a very moderate to increasing wind at our back.
All right. So in a moment, we're going to talk about how you went from there to the Stripe acquisition. But first, a quick word from the sponsors who make this show possible. The Stellar Development Foundation has launched Build Better, an initiative inviting bold ideas from the Web3 community. No coding or technical experience is needed. Share your vision for better finance, creativity, or access, and see it brought to life in Stellar's next hackathon. Developers will build real-world solutions on Stellar's fast, scalable, and sustainable blockchain. Submit your idea for a chance to win from a $30,000 prize pool. Get involved at betteron.stellar.org. The future of Web3 starts with you. Polkadot is the original and largest Layer 0 blockchain with over 2,000 plus developers. And the anticipated Polkadot 2.0 upgrade will be a massive accelerator for the ecosystem, upgrading the infrastructure with 8 times higher transaction throughput and twice as fast block times, perfectly tailored core time for the needs of every protocol, trustless bridges internally and into Ethereum, Cosmos, Near, Binance Smart Chain, and revised tokenomics and the implementation of a token burn to reduce inflation. Perfect for GameFi and DeFi to build, grow, and scale with one of the most active crypto communities in this space. Polkadot recently announced a partnership with Mythical Games, bringing top games like NFT Rivals with over 650,000 players and 43 million transactions to pave the way for GameFi and the Polkadot ecosystem. Get your Web3 ideas to market fast with economics that work for you. Think big, build bigger with Polkadot. Join the community at polkadot.network/ecosystem/community. Here's another listener comment in response to Travis Klink's thoughts on why Bitcoin ETFs are seeing record outflows. On X, Kane's Crypto Chronicles commented, quote, "Guessing it has more to do with people front-running those who bought Bitcoin ETFs early and are about to qualify for long-term capital gains starting next week." If you have a spicy take and want to hear it featured on the show, please write a review on Apple Podcasts or leave a comment on an episode on YouTube or X. Back to my conversation with Zach. So you briefly mentioned that you had worked at Coinbase, but before that, you and your co-founder had another previous startup, Evenly. So how was that working at Coinbase on USDC? Is that what kind of got you into stablecoins? Or how did you come to found Bridge?
Sean and I started together, and we started another company together 10 years ago or so. We knew we wanted to build something again, and we knew we wanted to do it together. We also were excited about the stablecoin space generally. And this was really due to two things. One was the time working at Coinbase. When I was at Coinbase, one of the things I was really excited about the launch of USDC. And in particular, I was running the consumer business at Coinbase. In particular, I was excited about the fact that USDC could be this global bank account. And this was in like 2009 or 2019. So that was like the first use case that I saw for USDC. And we took some steps to do that, and Coinbase took some steps to build that over the subsequent 4 or 5 years. But that kind of sat in my mind for a long time. And I had just sort of had this belief that a stablecoin could be this sort of financial building block on top of which someone could, offer a US bank account to folks internationally. And so we started, and we were building something a little bit different. But in the process of building that, we realized how hard it was to build with stablecoins. And that pushed us over a 3-month period to eventually pivot into building this infrastructure that would enable people to use stablecoins. We thought it was going to be so much easier to sort of take a dollar and settle it somewhere else as a stablecoin, or take a stablecoin in one form and convert it into another form. But it really ended up being very hard. And in the process, we realized our view of the stablecoin space was pretty contrarian, in that we thought that a lot of the reason why this infrastructure was not built is because there seemed to be an assumption in the stablecoin world that there would be like only one or only two stablecoins. And maybe even only one or two on one or two blockchains. And our view was that that's just not the way the world would play out. There would actually be many, many stablecoins on many, many blockchains. And so there would be immense value in enabling people to take fiat dollars, convert into any of these different forms of stablecoins, or accept any of these different forms of stablecoins and settle them back down into a currency you know and understand, and you're building your service on top of, whether that's a fiat dollar or a stablecoin dollar. And that was our view pretty early on. And so we thought that as the world moved in this direction, these APIs would become more and more and more valuable. In fact, like the more stablecoins there are on more blockchains, the more valuable it is for an orchestrator to help in the middle abstract away all of that complexity. And so we had pretty strong belief in like two things. This was like when we were starting the company, we were like, okay, we just have to believe two things. And if they're right, then our business will be meaningful. And if either one of them are wrong, we're not valuable at all. And it was one, that stablecoins will be important, and two is that there will be many. And if you believe both of those things, then we're in a pretty good position. And over the last 2 years, it sort of turned out that the first of stablecoins being important is becoming more and more true and more obvious. And that there will be many is also becoming more and more true and more obvious.
Okay, but when you say more and more obvious, like what do you think that will look like eventually? Like, I mean, we've seen there have been numerous, I think, categories where there tends to be just like a few that take the lion's share and then sort of a longer tail. Is that what your vision is? Or do you think it will be different than that, more diverse?
So I think that stablecoins, I think that there will be a few that aggregate very large amounts of liquidity, like USDC and USDT. They have proven to be really resilient. They will continue to be really resilient. There's very material network effects at play with those businesses. And you've seen how strong those network effects are with, the amount of effort and time that PYUSD has put into building their stablecoin and the limited adoption that it has received to date. That being said, I think there's like this huge swath of applications that really don't care about liquidity, or the liquidity is kind of like a afterthought. And many of those applications are financial in nature, fintech businesses and so on. And for them, the stablecoin is purely a ledgering mechanism. It's purely a money movement mechanism. It's under the hood, facilitating whatever activity they deem to be necessary. And in those applications, you have total freedom to pick whatever stablecoin you want to choose. And so many folks will choose to pick a stablecoin that they can control, that they can benefit from, so they get the yield from, that maybe they can program in a way that is helpful and unlocks some unique value for their business. And so long as it can be easily orchestrated into and out of fiat or other stablecoins, the liquidity piece is irrelevant. And so we think that there's going to be thousands and thousands and thousands of these other stablecoins, many of which people won't see. And many of them will be very large, like very, very large. I also think that over time, with more regulatory clarity, there's going to be a huge proliferation of tokenized deposits and other tokenized money-like products that will move and want to be interchangeable with each other and with these more open stablecoins like USDC. And you can kind of squint and see the beginnings of this market with JP Morgan and their stablecoin, which is huge. Most people don't talk about it, but it is enormous and enormously successful. So we think the stablecoin space is sort of going to be fragmenting, where you'll have these open stablecoins that are aggregating liquidity. You'll have these infrastructure stablecoins where there will be many, many, many of them. You'll have tokenized deposits and bank stablecoins. And there will probably be many more that we're not even thinking about because this market is incredibly early.
So let's go back to, just when you had your vision, how did you, or not like the initial point, but, when you were launching and you had certain conviction, but obviously you were facing all of these obstacles with all of these news events that were very bearish for stablecoins. How did you go from that to being acquired by Stripe for $1 billion and $1.1 billion a year and a half later?
There was no grand plan. And it seems like it's, looking back 2 years post-launch, it feels almost, impossible. But we basically just put one foot in front of the other. And it's not like there was no like magic playbook, but we launched our APIs. We built for a few developers at the beginning. They had an amazing experience. They told other teams about building with Bridge. They came and they had an amazing experience. They told other teams about building with Bridge. And this compounded for 2 years. And in the process, I think the thing that we were really good at over those 2 years is we were extremely good at listening to customers and helping unlock markets. So we didn't just launch our orchestration APIs and then those APIs became like huge and successful and we were just like holding on for dear life. I think that's what some companies do. None of these markets were big enough for that to happen. And instead, we launched these orchestration APIs and they kind of worked for some use cases.
And just to explain, an orchestration API, what is that?
Our orchestration API enables you to send in $1 and spit out a different one. So you could send in a fiat dollar and get out USDC, or send in USDC and get out USDT. And that was our first API. So, if you wanted to do a cross-border payment, you would use our orchestration API to take in a fiat dollar, convert it to USDC, and then take that USDC and then maybe convert it into a Mexican peso and then out to the consumer. And we launched our first API and actually it was bad. The first people building it with it were like, this is not helpful. We don't even really know how to use this or it doesn't work the way we logically think it would work. And we adjusted it to work for their use case. And then we had a cross-border payment company come and they were like, this kind of works, but isn't really what we need, but it's close enough. And there's nobody else who's doing this. So like, can you make these changes to make it work for us? And we worked with them. We really understood their use case. And in doing that, we unlocked the cross-border payment use case. And then with the payouts use case, that came to us with the aid disbursement. They needed a totally different set of APIs to be able to disperse aid payments, because then you're not doing one-off payments, you're doing one payment in and 10,000 different payments out all at the same time. And we worked with them and we made that use case work. And then we had these neobanks who wanted to use our orchestration APIs, but they didn't work the way they needed them to either. And so we had to go to our banks, we had to go find different bank partners. We had to build totally different APIs. We spent like 5 months rebuilding a bunch of our infrastructure to work for their use case. And then in doing that, we unlocked this whole neobanking market that could build on top of us and so on. And so we didn't just like launch one thing and it became successful. Instead, we had sufficient demand and inbound interest to give us really good feedback. And then we were excellent at incorporating that feedback and then building APIs that could layer on more and more and more use cases to help our business compound. And we did that 5 or 6 times over the course of a year. And the combination of all of those meant that our business was growing immensely. And we were now able to serve like a huge swath of businesses and entrepreneurs who wanted to create in the space. And we have always had a really strong inbound funnel of people who've just been coming to us because they've known other people who've had a really great experience building with our APIs. And so that just happened. We just compounded that over 2 years. And I think that worked very well for us. And then, while at that moment in time at SVB, I think that it felt like we had got the timing wildly wrong. It turned out that we got the timing like wildly right. The fact that we were building through a period of time when no one else was building meant that by the time that there was excitement about the space, we were miles ahead of everyone else. And this building momentum and use case, which I think we helped create, really put us in a very unique position and still does towards the end of the year. I think we're like if you're someone building on top of stablecoins, our platform is the best place for you to go. to build whatever it needs to do. And whether you're the largest financial services company in the world, or whether you're, a team that just entered YC.
And so then how did Bridge and Stripe initially become acquainted?
We met at a meeting with a regulator. There was the deputy secretary of the Treasury was doing a tour around a listening tour through meeting with a bunch of companies. And that meeting was the first time I think I had spent time with Stripe. But before that, though, I was, and this was like first time I'd meaningfully spent time with them, although it wasn't like direct one-on-one time. It was still a small meeting with this person. Before that, though, I was like aggressively trying to find a way to sell to Stripe. And I couldn't for the life of me. We had tried like everything under the sun. I mean, honestly, Stripe was like picking and using every other vendor in this space besides us. And so I was like trying to find a way for us to support them, and I just couldn't. And so I hoped that by going to this meeting, it might be some way in which I could better sell and position Bridge so that they could use us for something even really, really small.
And so then how did the acquisition come about? Did you finally just get to pitch them, or like what happened?
Not really. Like we didn't set about selling the company. So it really came because, so I was trying to sell to Stripe, and I knew there were a bunch of things that Stripe wanted to build and that Stripe was investing in or had invested in. And I thought that Bridge would be a better way of doing those things or building whatever the next thing is that they wanted to do. So I was spending a lot of time with them and trying to, push on our investors and so on to introduce me to people, because I knew that if we won the Stripe business in any capacity, it would be a huge tipping point for our company. We've just seen, we get one or two of these like big customers. It unlocks markets for us, because then other customers that are in a similar category feel comfortable using the same person that XYZ business uses. And so that was it. I mean, over the summer, I was just like I was trying to sell to them. And I think in the process of that, they had two things had happened. One, which was well beyond us. One was that they had a very long-standing belief in crypto generally, and increasingly in stablecoins specifically. And Stripe as a company has been in and out of the crypto space for a long time. I mean, in fact, when I joined Coinbase when pay with Bitcoin was like Coinbase's main business, or at least was it's like the company thought it was going to be its main business. So this is like you could pay at overstock.com with Bitcoin via Coinbase and stuff like that. And Stripe was the biggest customer of this product at the time. And so they had, and this was like 2018 or so. And so they have been in and out of the space, and I think really in a way where they have been trying to find ways to use, like proactively trying to find ways to use crypto to better their merchants and better enable global commerce. And so they had a longstanding belief and had come with very much a prepared mind in this space. And two, I think that when they learned about the use cases that we were supporting, it's kind of like it seemed obvious. It was like a why hasn't this been built before type of thing. And it was pretty clear how our business could help a lot of Stripe merchants, and how Stripe could really help accelerate our business. So all those things came together, such that as I was selling really aggressively, I think it clicked that maybe it would make sense, maybe it would make more sense for us to partner versus have a, vendor customer type relationship. And then from there, things moved very quickly.
Okay, yeah. It's funny the time frame that you mentioned, because I remember there's some part of my book where there was like some kind of secret something or other about Ethereum, like, people trying to just the little backroom stabbing and whatever was going on. But anyway, but what was funny is that somebody said to me something about some dinner somewhere, blah, blah, blah. And they mentioned all the different people that were part of this. I remember the Stripe founders were in this list. But it was at a time when like what they were doing in crypto wasn't really known. So I remember being like, so like, wow, I didn't know they were into all that. Anyway, I was never able to verify it. So hopefully I'm not spreading misinformation. Well, I'm not even saying what any of it was about. So, but anyway, point is just now things are clicking for me. So how does Bridge make money?
We make money by charging fees on the money that we move through our system. So that's the majority of the way we make money. We have some other ways too, but the overwhelming majority of the funds, the money we make is you're moving money through our orchestration API. So fiat comes in and then a stablecoin spits out, and we take a small fee for facilitating that money movement.
Okay. But meaning like the more volume, the more money you make, or is it? Oh,
exactly.
Okay. Got it.
Exactly. The more volume, the more you use the product, the more money we make. So, if you're a developer building on top of our APIs, we really just want you to be successful. Our interests and your interests are totally aligned.
Yeah. And it's cheaper for the companies, which is why. Yeah.
Yes.
So,
yes.
Do you foresee any issues where, for instance, like a bigger TradFi firm could cut off access to the payments infrastructure that you need for your business?
I mean, we are dependent on banks for sure. And this was like a very large problem for us when we were getting started, is that we couldn't find partners to work with, banks that were willing to invest in really learning and understanding our business. And so that's one of the big reasons why we had to start and stop. And, it took us so long to get from idea to a live product. I mean, it took us a year. So yeah, so we are very worried about that. I think that it seems like, I knock on wood, it seems like we are past the worst point and the most risk in that dynamic.
And when you say that, you're speaking about the political winds that are about to shift next week?
Yes, exactly. I mean, it was very bad. It was like, everything that folks sort of read, it was like we experienced that, our customers experienced that. I mean, it was such a headwind for our
just
business.
Give some examples.
Like, I'll give a very concrete one. Even today, there are certain payment rails like Swift that we cannot access. Like, even though, if we wanted to use that payment rail for whatever reason, we can't. There is no digital asset company in the entirety of the United States that I know of that has access to the Swift payment rail. And the way you get access to it is through a US bank and so on. And so it just doesn't happen. There's only a handful of banks, maybe not even a handful of banks. Maybe there's like 2 or 3 banks that have taken the time to educate their regulators on digital assets and invest in the space. And I would say we've had probably dozens of teams who have been building on us who have had to shutter or pivot because they couldn't find, downstream bank partners in some way, shape, or form to support their business. So beyond just like the clear thing of like, it took us a year to find a bank partner and so on, there's still there's still core infrastructure that we're struggling to access. And many of the developers building on top of us have, been very, very negatively impacted.
And just to understand that about Swift, is it that the Swift entity will not allow it, or is it that regulators won't allow it, or is that the banks don't want to test the regulators, or like what's going on with that?
It's honest. It's like a very frustrating situation where there are a handful of global banks that will support Swift payments for digital asset companies. But in order to do that, they charge insane fees. So maybe they charge 30 bips or something, to 30 basis points to move money via Swift, which is a crazy amount of money. I mean, imagine you're moving hundreds of thousands of dollars and that your banking infrastructure wants you to pay, hundreds or thousands of dollars in fees to move one payment. It's insane. Right. So who's going to use that rail? Only the people who are the riskiest, the most willing to pay because, of whatever reason. So then what ends up happening is Swift is like, well, we're seeing a lot of fraud on Swift with digital asset companies. And it's like, yes, because you have not because it's digital asset companies, it's because you have structurally set up the market such that only the riskiest companies would ever be using this rail because of its pricing, because they have no other rails to access globally. So one of the things that we've been really trying to convince bank partners is that we're not competing with these other digital asset things. We're competing with banks. We're competing, and our customers don't look at us like, they're not comparing, us versus some other very risky, Swift partner or something. They're comparing us versus a bank. And that's the market that we're going after. And as a result, we need pricing and access and, underlying financial infrastructure at unit economics that are comparable to a bank. Otherwise, it just doesn't work. And so the market right now is just structurally set up such that it is very challenging for any digital asset company to access this rail. And the same thing is true with other rails too. I mean, anytime that a bank is trying to, I understand what they're doing. They're trying to charge more to compensate for the risk that they're doing, but it is self-selecting the market into only the riskiest companies moving to use that product.
Yeah, and honestly, this is so interesting just because as you're describing this, it just makes me think of every story of disruption where, the fact that they're charging that fee is what is going to kill their offering in the long run and make the competition a no-brainer eventually. And so they're just setting themselves up for disruption, basically. But one other thing that I want to ask you about is, I've heard you mention that you or that the users on Bridge have extremely low incidences of fraud. And, I think because it's B2B, that's how you can do that. So just explain kind of the compliance setup and, what hoops you've had to jump through and, how it is. Because I would imagine that now you're just dealing with so many jurisdictions. So there's probably some complexity there.
Yeah, there's a ton of complexity, and we have we've invested an enormous amount in this piece of our business because we've known from the beginning, we've known that if some other fintech starts working with a bank, they start at 0. Or maybe they start at 5 or something, and they build trust. We start at -10. And then we have to build our way back to neutral, and then from neutral we can build into the positive territory. And so we have less than 1 basis point of fraud across all of Bridge today. Which is phenomenal. Like it is, you could compare us to basically you could compare us to a bank. We have way less fraud than a bank. You could compare us to a US based fintech. We have way less fraud than them. And especially you could compare us to anyone who's dealing with folks internationally. And we would be, many standard deviations away from the mean. I think that the fraud has, there's definitely the compliance piece, which has been a huge investment for us. And that is like, because we're KYCing and we're doing, risk management on end users who might be from all over the globe. The other thing that we have done where we've been very thoughtful is how we allow our customers to structure transactions, which really mitigates a lot of this fraud. So a great example here is that we just don't support reversible payment methods. So we just don't support an ACH pull or a card payment or any of these others that are really rife with fraud and chargebacks. And that's like an enormous market, but one that we just have felt is not at some point, and especially now that we're partnering with Stripe, we'll probably do more here. But over the first 2 years of the company, the juice hasn't been worth the squeeze, or at least the perceived juice for us. And that's meant that if a consumer or a business is sending money through Bridge, they're always doing a push payment. They're logging into their bank. They're putting in the bank account and routing instructions. They're doing all the confirmations at their bank, and they're sending the funds. And this has really limited a lot of the use cases that we can support. But we've done that because it is by far the safest and most secure and least risky means of facilitating payments through this system. And then the main, with this, the main risk to us comes with other compliance issues, which might be money laundering or identity theft and account takeovers and that sort of thing. And so we can focus our compliance efforts specifically on those issues instead of trying to fight every potential compliance issue all at the same time.
But do you have to do compliance work for every jurisdiction you're in, or?
Yeah. Well, we operate primarily out of the United States and Europe. So we KYC and onboard and manage, user compliance up to the standards that apply to the jurisdiction into which we are onboarding the user. So we might be onboarding a user in, Mexico via our US entity. And so we would be adhering to US compliance and KYC and anti-money laundering and so on obligations in the US.
Oh, okay. But let's say that it's, making a payment from Mexico to the Philippines. Then do you need compliance for the Philippines too, or no?
That would depend. Oftentimes, we have done some payments that are country like that, but almost all of our payments move through the US or Europe in some capacity. And so we use our US or European entities we onboard users into our US or European entities.
Oh, I see. So you don't need the full compliance for every single jurisdiction where oh, okay. Got it.
Yeah. So we're not regulated in the Philippines, for instance, or some other country. Yeah.
Okay. And then you talked before about how you believe that there will be some sort of long tail of stablecoins. What criteria does Bridge use to decide which stablecoins it will work with? I don't even know, at this moment in time, are you only doing reserve backed, or how are you choosing?
We're pretty agnostic. I mean, we will work with more or less whatever stablecoins our developers want to work with.
Even a USDE or?
Yeah.
Oh, okay. Oh, cool.
Yeah. We don't take risk on the stablecoin, so it's not really like a risk decision on our side. And so we are, and we very purposefully just want to be neutral. So we're willing and game to support whatever asset our developers feel most comfortable or most incentivized or most excited about using.
Okay. And so I view the stablecoin space right now as being at a really interesting, what I would consider inflection point, partially because of this political change that we talked about. But, as you know, around the time you launched, or I guess, yeah, this was playing out over the course of years, but USDT was like dropping in market share as USDC was ramping up. But then after the depeg now of USDC, USDT has become dominant again. And here we are at this position where, people saw in 2024 just how much money Tether was making. And now there's a whole host of new competitors that are, some of them have just launched, others are about to launch. There's Ripple stablecoin, there's the USDG, which is formed from a partnership of Robinhood, Galaxy, Kraken, Anchorage, et cetera. Just generally, what do you think will be differentiators when it comes to this stablecoin composition? Like, what do you think will give any one product an advantage over others?
I think it's a great question, and I wish I knew the answer. I can give you my best guess. I think that there will be a few different vectors of competition. I think that a general purpose open stablecoin that aggregates liquidity and its primary use case is liquidity pairs on dexes and exchanges. I think that market is pretty mature and is settling into some form of equilibrium. Now, USDC might, they're playing around with their economics and seeing what they can do, and maybe they're going to gain some market share, and maybe something bad happens to USDT, or something bad happens and that shakes up the space. But assuming that doesn't happen, I think we're going to settle into some form of equilibrium here, where those two are going to be the dominant stablecoins that folks use. Then I think that there will be other stablecoins that compete based on economics, which might win certain use cases. And there will be many other stablecoins that compete based on distribution within their own platforms. And so that's kind of like what you see with USDG, where they're pushing, specific platforms that have large consumer bases, defaulting that as the stablecoin within their worlds. And maybe adoption grows outside of it, but even if it doesn't, and they just have adoption within the ecosystem of USDG participants, it'll be pretty successful. And I think that, and the same is true, like JP Morgan's another great example, is that like they don't care about competing in the DeFi world, but their stablecoin has trillions of transaction volume. And so it's hard to say that it's not successful. It's just competing along a very different vector as sort of internal settlement across all the JP Morgan entities. And I'm sure at some point in time, JP Morgan has designs of opening it up and enabling other banks to participate. And we'll see if that ends up being successful. But I think that most people today think of the stablecoin space as the first category, which is liquidity pairs in DeFi. And as a result, jump to the conclusion that the space is sort of mature and it's going to be very hard for others to compete. And there's only going to be two companies. And I think that is just one of the use cases of stablecoins. And if this space is successful, we will have many, many different use cases. And it's going to be very challenging for the same stablecoin that is optimizing for winning liquidity pairs to be the stablecoin that wins in the JP Morgan use case, that is the stablecoin that wins in like the FinSec infrastructure use case, and so on.
Yeah. this actually reminds me that when I had Vlad Tenev on the show and I asked him about USDG, he said that, Tether's keeping all of that money that they're making, but that something like a USDG could pay that back to the customers. So clearly there's room for other types of stablecoins. So at this point, like, who does Bridge think of as your main competitors? And now with this Stripe acquisition, like, what are the plans for you two together?
So I would say our main competitors continues to be, and probably for the years ahead, will be the fiat infrastructure, landscape. So like a great example is that we are moving into the card issuing world. So card issuing is when you issue a card, you need a partner to issue in the US, a partner to issue in Mexico, a partner to issue in Brazil, a partner to issue in India, a partner to issue in Europe. So it's very challenging to launch a global card because you might need to stitch together 10 or 20 or 50 different partners. And so it becomes enormously costly. With stablecoins, you can now give all your consumers a stablecoin-based balance, and then you could issue a global card on top of the stablecoin balance, because a consumer can hold the stablecoin balance in any country. And your consumer, you don't even have to know that a stablecoin is there. It is literally just infrastructure that's global, so you don't have to piecemeal all these different bits of infrastructure together. And it's a better way of issuing a card. The primary competitor there is the old model. The primary competitor there is the model of stitching together all these pre-existing card issuers. And that model is proven, and no one's going to get fired for doing that model, but it is way slower and way more expensive. And so our job is to help people understand that the risk is not as high as they might perceive it to be. And to win against these, very imperfect but established competitors. And the same thing is true on our orchestration APIs. A lot of the things that we're competing against are just fiat infrastructure. Other fiat money movement companies, other global fiat, FBO type products, which is like a stored balance type product. And so that's our main competitor. Say that again.
For benefit of?
Yes,
FBO?
for benefit of, exactly. And, together with Stripe, this is, so our business has been, from the very beginning, inbound driven. So, when the Stripe acquisition was announced, we had literally 10x more inbound leads than we had ever had in a previous week. And Stripe, there's two aspects of Stripe that are going to be extremely helpful for us as we build the business. The first is that they lower the risk for people to work with Bridge. There are many folks who were hesitant or were not even considering working with us before, who are now willing to, because they now know that we've been vetted by and we have the support of Stripe. The second thing is that Stripe is one of the most global financial services companies. And they have, dozens of different teams building global products for merchants or consumers or whatever else. And all of those folks are now going to be able to and want to and motivated to build with our APIs, which will also help show, those products ultimately will become successful, but they'll also show the rest of the world what is possible. Which will then sort of feed this loop where more people will come and build with us. And so excited about, both of those things. One is, with their support, being able to really widen the aperture of the folks that we can and who are excited to work with us. And then two, build with Stripe. And as they launch products, inspire, many others to build similar or different or, different products with stablecoins.
Yeah, I remember I think it's like early as 2016 or something, I was at this retreat on Richard Branson's Necker Island, and they were asking like one of the people who was working there about the remittances that she sent home. And she was saying that she was paying like 30% just on the fee alone.
Crazy.
And I remember, back then we were talking about how this was so ripe for disruption. And I feel like it's taken 9 years basically for now Bridge to be the company that is like poised to actually deliver on those types of savings. Stablecoins are currently overwhelmingly denominated in US dollars. About 99% of them are in US dollars. I find that so fascinating. Why do you think that is, and how quickly would you expect other fiat currencies to become a greater proportion, or do you feel like this is sort of the kind of global, currency of finance, basically the way that like so many people in the world are learning English, or how do you view that?
I think that there will be many different stablecoins, many, non-US dollar stablecoins. But I do think that the overwhelming majority of like global AUM will remain in US dollar stablecoins. So today there is just, consumers and businesses are speaking with their wallets and they are only demanding US dollar stablecoins. There's sort of two aspects of this. One is that first use case that we talked about of like the trading use case. That's just globally denominated in dollars, so that wins. The second factor is that the other big use case for stablecoins is just meeting demand for dollars. There is just immense global demand for US dollars that is undermet by fiat dollars, and so people are swimming to US dollars. And then one other thing is that one other factor propelling stablecoins forward is that they are, in many countries, is particularly popular in LATAM, is that there's trading and arbitrage opportunities between the FX market. So like the stablecoin to Mexican peso market might trade slightly different than the US dollar to Mexican peso market. And most global FX markets are, the trading pair is denominated in US dollars. So this market will likely match the FX market, which is dominated by US dollars. I do think that other currencies will become very important. And I also really hope that they do, because it will meaningfully accelerate the utility of stablecoins. If you could convert from a US dollar stablecoin into a Mexican peso stablecoin, a Mexican peso stablecoin into an Argentinian peso stablecoin, and so on. But I think the primary use case for those will be the end sort of off-ramp or pairs for stablecoin FX. And so I don't know how much consumer adoption there will be, but I think it will primarily be a like FX trading adoption use case that facilitates faster global money movement. And so part of it is I believe it will exist. And the other part of it, which might be equal, is that I hope that it exists.
Yeah, I mean, just the way you were talking at the beginning about how it's mostly international use cases, I would imagine it is the jurisdictions where the money is just a weaker currency, where those people are drawn to these stablecoins. So it makes sense that even if it were in their local currency, they would prefer to keep their money in US dollars. So yeah, so even if one day there is like the full spread of all the current fiat currencies in stablecoins, I do imagine still, even then, they would all be in smaller proportion to their proportion in the fiat world.
Yeah.
So.
I mean, right now, if like the fiat FX market, I have no idea, is like 60% US dollars, 40% everyone else. Today the stablecoin market is like 99.9% US dollars, point oh whatever percent, everything else. I think that will change. It might be 80-20, it's not going to be the same, but I think that will change.
Yeah. All right. Well, Zach, this has been so fascinating. Where can people learn more about you and Bridge and Stripe?
You could visit us, visit Bridge online. We're just bridge.xyz. And then I am mostly on Twitter. So at ZC Abrams, ABRAMS.
Perfect. Thank you so much for coming on Unchained.
Yeah. Thanks for having me.
All right. Well, thanks to everybody for joining us today. To learn more about Zach, Bridge, and stablecoins in general, check out the show notes for this episode. Unchained is produced by me, Laura Shin, with help from Matt Pilchard, Wanda Ranovich, Megan Gavis, Pam Majumdar, and Margaret Correa. Thanks for listening.